Why do so many people spend decades working only to stay completely broke, while others quietly build immense wealth? It often starts with a trap known as the 30K millionaire, individuals earning a modest average salary who dedicate every dollar to maintaining a wealthy aesthetic. They buy the VIP table at the club, but cannot actually afford the drinks. To keep up the act, they rely on borrowed money to finance things that actively lose value over time, like luxury cars, fine designer clothing, or expensive watches. When you take out a high-interest loan to buy a depreciating asset, the math turns brutal. You are paying a bank extra money for the privilege of financing something that is actively dropping in value. You are paying money to lose money. Breaking out of that cycle means completely walking away from the performance of wealth. It requires executing a concrete three-phase mathematical blueprint. Phase 1 is the foundation. During these first few years, your portfolio's growth depends on the volume of cash you contribute rather than the returns you earn. This chart shows the composition of a $100,000 portfolio over 6 years. If you invest $13,000 a year at a 7.5% return, you reach that six-figure mark. But 77% of that total balance is comprised entirely of your raw cash savings. The initial friction is high. Building that initial mass of capital requires strict delayed gratification, which boils down to a single rule. If you cannot buy it twice, do not buy it. Say you want a $500 PlayStation 5. You have the cash. But if the thought of a $1,000 purchase makes you incredibly uncomfortable, you cannot actually afford the $500 console in the first place. Keeping that discipline intact means closely tracking 3 metrics: your fixed expenses, your savings rate, and your net worth. The most critical of those is your fixed expenses: housing, transportation, utilities, and insurance. These baseline costs must never eat up more than 50 to 60% of your total income. Surpassing that 60% mark suffocates your ability to invest. Pouring a strong foundation relies entirely on capping those lifestyle costs and mastering impulse control, not on securing a massive salary. Once the foundation is poured, you move to phase 2, the engine. But the financial industry often sells the illusion that this engine needs to look like the high-stress, chaotic floor of an active trading desk. Many casual investors assume they are acting responsibly by buying 10 to 12 different exchange-traded funds, hoping to spread out their risk. But holding multiple funds from the same provider usually creates massive redundancy. If you buy Vanguard's S&P 500 ETF and then add their mid-cap value ETF, over 92% of the mid-cap's holdings are already inside the S&P 500 fund. You are concentrating risk, not diversifying it. True diversification can often be achieved by holding just 1 or 2 broad market index funds, letting the market do the heavy lifting. It sounds overly simple, but casual investors holding a basic S&P 500 index have historically outperformed 92% of large active fund managers over a 15-year period, according to S&P Global. The most effective wealth engine requires you to reject the noise of the financial entertainment industry and fully embrace brutally boring, passive simplicity. There is only one variable required to guarantee the success of a boring portfolio, and that is a multi-decade time horizon. Analysts use the price-to-earnings, or PE ratio, to gauge whether the stock market is currently expensive or undervalued. This chart plots PE ratios against future returns. When stocks are expensive, investors often see negative returns over a short 5-year window. Stretch that to 15 years, and those negative returns rapidly diminish. Over 20 years, U.S. stocks almost never yield negative returns. It's why financial author Morgan Housel argues the most profitable action an investor can take is literally losing the password to their brokerage account. Over decades, the noise of market volatility fades away, letting average returns compound into significant wealth. Once the foundation is laid and the engine is running, you enter phase 3, the fortress. Because the greatest threat to your financial security is no longer the market, it is your own psychology. Comparing your day-to-day life against the curated social media highlights of your peers triggers impulsive, wealth-destroying decisions. The reality of the millionaire next door is that true wealth is largely invisible. It exists in the form of untouched index funds and paid-off mortgages, rather than what is publicly spent. Adopting the financial tactics or risk profiles of friends or influencers is incredibly dangerous, precisely because their actual, behind-the-scenes financial reality is completely unknown to you. The entire master blueprint relies on all three pillars holding together: saving aggressively, investing simply, and defending your mind. But your neighbor's risk profile isn't yours. Even the best general advice requires a personal filter to determine if a specific strategy fits your individual timeline. Financial freedom is the long-term yield of endurance. It is the result of executing boring habits consistently over a lifetime.